stop what you're doing. Because while everyone was staring at medals and memes and market headlines, the real switch just got flipped in the darkest corner of global finance. Japan, the country that has spent decades pretending interest rates were a myth, is suddenly paying real yields again. And that sounds boring until you realize it's the same as yanking the power cord out of the global economy. Now, before we go any further, my YouTube analytics show a huge chunk of you watch every video, but you're not subscribed. If you value this kind of breakdown, hit subscribe right now and drop a quick comment like ARGAG, so the algorithm knows this is worth pushing. Alright, here's the setup. For years, Japan was the world's cheat code. If you wanted cheap money, you went to Japan. If you wanted to borrow at almost nothing, you went to Japan. If you wanted to do the carry trade, borrow yen, buy everything else, Japan was the fuel. That wasn't just a Japan thing. That was the invisible engine underneath stocks, crypto, real estate, venture capital. Basically, the entire everything bubble. And now that engine is stalling. The numbers look harmless if you don't understand the context. A 10-year Japanese government bond yield around the low twos, a 30-year pressing toward 4, a 40-year poking above 4. If you're in the US, you glance at that and shrug because you've seen higher yields before. But Japan is not the US. Japan is the opposite of the US. Japan is the place where investors learn to live with 0% and even negative yields. In Japan, a move like this is not a speed bump. It's a cracked axle on the highway. And here's the part most people miss. Japan isn't just another economy. Japan is the creditor country. Japan is the vault. Japan is the global savings machine that has been exporting capital for decades. When Japan earns nothing at home, its institutions go hunting abroad. They buy foreign bonds, they buy foreign stocks, they buy US treasuries. They buy the safe paper that keeps the global system glued together. So when Japan's home yields rise, something dangerous happens. The incentive flips. The money doesn't need to leave anymore. It can come home. And when money comes home, it doesn't tiptoe. It drags liquidity out of everything it touches. If you want a simple mental picture, imagine global markets as a giant pool. For years, Japan was pouring water into that pool. Now, the hose is turned off and the drain is open. You don't notice at first. The water level just drops a little. Then the shallow end gets weird. Then the deep end starts to expose what was hiding underneath. And finally, people realize the pool isn't low, it's emptying. This is why the bond market matters more than silver, more than Bitcoin, more than whatever trend is loud today. Because the bond market is the funding market. The bond market is the price of money. And when the price of money rises in the wrong place at the wrong time with the wrong debt load, you don't get volatility, you get forced selling. Japan's debt burden is massive. When you carry that kind of debt, you can't tolerate higher rates the way a normal country can. Higher yields don't just hurt. They eat budgets. They devour tax revenue. They turn governments into debt service machines. And that's why Japan spent years doing the unthinkable, the central bank buying huge amounts of its own government bonds to keep yields pinned down. It was a policy, yes, but it was also a confession. It was Japan admitting if we let the market set the price of money, the math breaks. So, what changed? The currency. For a long time, Japan could suppress yields and tolerate a weak yen. But a weak currency is not a free lunch forever. A collapsing yen makes imports more expensive. It makes energy more expensive. It makes food more expensive. It turns everyday life into a slow squeeze. And eventually, a country faces the impossible choice: protect the bond market or protect the currency. When you protect the bond market, you keep yields low by printing and buying bonds, but you weaken the currency further. When you protect the currency, you stop printing and stop buying. and the bond market gets hit with reality. Japan is being forced toward reality. In reality, in a debt-heavy system looks like this, bond prices down, yields up, and balance sheets that suddenly don't add up. Now, let's talk about why this reaches into your life, even if you've never owned a Japanese bond in your entire existence. Because Japan's institutions have been holding a gigantic stack of foreign assets, and those assets aren't some niche corner. They're the big stuff. US government debt, US equities, the same mega cap stocks sitting inside your retirement account, the same indexes everyone feels safe owning because they've only gone up for so long. Here's the pivot. If Japanese institutions can earn a meaningful yield at home in their own currency without FX headaches, the reason to keep foreign exposure shrinks. And if they also have losses at home from falling bond prices, the pressure to raise cash grows. That's repatriation. And repatriation is not a vibe. It's a flow. It's money moving in size. Let's slow down and make this crystal clear. When yields rise, bond prices fall. Japanese funds holding piles of domestic bonds see their safe holdings lose value. That creates holes in balance sheets. When you have holes, you patch them. And the easiest patch is to sell what is liquid and what has gains. Often, that's foreign equities. Often, that's US tech. Often, that's the same crowded trade every global investor has been swimming in, so the risk isn't Japan's economy slows. The risk is Japanese capital exits global assets. And when a big holder becomes a seller, markets don't care about your feelings. Markets care about supply and demand. Now, here's where the story gets nasty, because it doesn't stop at they sell stocks. There's a second bomb, the carry trade. For years, borrowing in yen was basically free. Funds borrowed yen, swapped into dollars, and bought higher yielding assets. Stocks, high yield credit, emerging markets, crypto, real estate, anything that looked like it could outrun a near zero funding cost. But when Japanese yields rise and the yen strengthens or becomes expensive to borrow, that trade gets squeezed. And a squeeze trade has one universal outcome: liquidation. They don't unwind because they want to. They unwind because margin forces them to. That's why you can have a day where nothing new happens in the news. And yet markets drop in a way that feels irrational. It's not irrational. It's plumbing. It's a funding unwind. It's leverage getting reversed. And the worst part is this unwind is self-reinforcing. Let me explain that loop in plain terms. Step 1. Japan's yields rise. That signals tighter conditions in yen funding. Step 2. Positions funded with cheap yen become less profitable or outright dangerous. Step 3. Funds reduce risk. They sell assets bought with that funding. Step 4. The selling causes prices to drop, which triggers more margin calls. Step 5. More margin calls mean more selling. The loop feeds itself. And now you see why this matters to everything. Because it's not a single market story, it's the story of global liquidity reversing. If you've been investing for the past decade and a half, you've lived in a world where liquidity kept bailing everyone out. A dip happened. The printer appeared. A crisis showed up. Rates got cut. A crack formed. A central bank pasted over it. But what happens when the crack is in the place that was supplying the cheap funding? That's Japan. This is why some people call Japanese bond turmoil the widowmaker. For years, traders tried to short Japanese bonds or bet on rising yields. And for years, they got destroyed because the central bank kept buying and buying and buying. Betting against that was like stepping in front of a train. But here's the twist. The train is running out of track. The currency constraint is tightening, and the market is starting to call the bluff. So where does this go? There are 3 paths, and none of them are comfortable. Path 1. Japan tries to recap the bond market by massive buying again. That stabilizes yields, but risks crushing the yen further. Path 2. Japan lets yields rise and accepts pain in the bond market and fiscal math. Path 3. Some messy hybrid interventions, policy tweaks, temporary support, but still a slow drift toward higher yields. No matter which path they choose, global markets are not returning to the easy money environment. That chapter is closing, and the closing isn't cinematic. It's mechanical, it's flows. Now, let's connect it to the United States because this is where the global situation turns into a direct threat to your portfolio and your cost of living. Japan is one of the largest foreign holders of U.S. treasuries. If Japan reduces buying, U.S. debt auctions get harder. If Japan actively sells, U.S. yields rise. And when U.S. yields rise, everything that depends on cheap financing starts to wobble. Housing, auto loans, corporate debt, regional banks, the whole structure that assumes low rates. That's why the Japanese situation can be a trigger for U.S. financial stress, even if the U.S. economy looks fine today. Because yields don't care about vibes. Yields care about buyers. Now, I want you to sit with this question for a second. If one of the biggest buyers steps away, who replaces them? That's the Fed's nightmare. Because in a world where deficits are large and debt issuance is relentless, the bond market needs constant demand. If foreign demand weakens and domestic demand doesn't scale enough, there's a buyer left with infinite capacity, the central bank. And when the central bank becomes the buyer of last resort again, you don't just stabilize the bond market, you debase the currency. That's the trade-off. That's the cost. So if Japan's crisis leads to a scenario where the Federal Reserve must support the treasury market more aggressively, that's the bridge back to hard assets. That's the bridge back to why people run to things that can't be printed. And yes, that includes silver and gold. Now, quick side note, and I'm going to be very intentional here. If you want daily updates, quick posts, and my personal analysis that I don't always put on YouTube, I've created a WhatsApp channel. It's where I drop premium-style updates, instant voice notes, and quick alerts when something important hits the tape. The link is in the description. Join it because those fast moments are exactly when the average investor gets blindsided. All right, back to Japan. The scary part is not that this could cause a crash. The scary part is that it could create a long, grinding regime change. A market where rallies get sold and dips don't rebound the way people are trained to expect. This matters because most retail investors are conditioned to one strategy: buy the dip. But buy the dip works when the marginal force in markets is liquidity. When liquidity is rising, dips are opportunities. When liquidity is falling, dips are traps. And Japan is a liquidity story. Let's talk about forced selling in the slowest, ugliest form. Structured liquidation. When a large institution needs to adjust its portfolio, it doesn't slam a market order and blow everything up. It sells into strength. It uses rallies as exits. It spreads the selling over weeks, months, sometimes years. That's how big money moves without making headlines. So, you might not get a single dramatic day where everything collapses. You might get a market that feels heavy. You might get a market where every rally stalls. You might get a market where everyone is confused because the news is positive but prices keep fading. That's a distribution regime. And in distribution regimes, the biggest danger is psychological. People keep thinking this is the bottom. This is the bottom. They average down. They chase little rebounds. They get chopped up. Meanwhile, the real seller is calmly unloading. Now, let's layer in the currency effect, because this is where the repatriation story becomes even more intense. When Japanese institutions sell foreign assets, they often convert proceeds back into yen. That means they sell dollars and buy yen. That pushes yen higher. And when yen rises, the carry trade gets squeezed harder. So the act of repatriation itself can tighten global financial conditions further. You see the trap? The unwind accelerates itself. This is why I'm calling this Japan pulling the plug. It's not a metaphor. It's describing a withdrawal of cheap funding that the global system quietly depended on. Now you might be thinking, okay, John A.G., but does this really hit mainstream investors? Or is this a hedge fund problem? It starts as a hedge fund problem. It ends as everyone's problem because hedge funds don't sell to other hedge funds in a vacuum. They sell into public markets. They sell what you own. They sell what's liquid, and the ripple spreads. If you've ever wondered why a sell-off can hit stocks, crypto, and credit at the same time, it's because they share the same funding source in moments like these. Now, I want to pivot to the part that most people get wrong. The story is not Japan is doomed. Japan is not a meme stock. It's a complex country with real manufacturing, real savings, and real institutions. The story is the system. The story is the global architecture built on leverage and low rates with Japan as a core pillar. When a pillar shifts, the building cacks. So what does a smart viewer do with this? First, you stop treating this like entertainment. This is not news. This is a structural change. Second, you start watching the right indicators. Japanese yields, yen strength, US Treasury auction demand, and global liquidity metrics. Third, you prepare a plan, not a panic, a plan. And in a moment, I'm going to give you that plan. What to watch, what to avoid, and what to consider as shelter. But before we get there, I want to ask you something. Because I read the comments and I actually used them to shape what we cover next. Do you think this is the start of a full global deleveraging? Or do you think central banks will smother it again with liquidity? Drop your answer below and tell me what you're holding right now. Cash, stocks, metals, crypto, or something else. Now, here's the next layer. The US Treasury market. You can have a stock market correction and recover. You can have a crypto crash and recover. You cannot have a Treasury market confidence crisis and pretend nothing happened. The Treasury market is the foundation. It's the collateral. It's the benchmark. It's the thing everything is priced off. If foreign demand weakens, the US has two choices. Pay higher yields to attract buyers or have the central bank absorb supply. Higher yields mean pain. Central bank absorption means debasement. And usually in an election-driven debt-loaded system, debasement is the path of least resistance. It's the quiet tax. It's the one most people don't understand until it's too late. This is why, historically, episodes like this end with the same solution. A bigger balance sheet somewhere. Now, this is the part where I need you to hold on to the thread, because it's easy to get lost in the mechanics. What I'm about to say is simple, but it's uncomfortable. When a system has too much debt, it cannot tolerate high rates. When rates rise anyway, something breaks. When something breaks, policymakers choose between default and printing. Most of the time, they print. And printing doesn't feel dramatic on day one. It feels dramatic when prices reprick. This is where hard assets come back into the story. Not because hard assets are magical, but because they're outside the promise-based system. Now, I'm going to insert something that a lot of creators avoid saying because they're afraid of the comment section, but I'm not. If you're holding a portfolio built on the assumption of permanently low rates, you're holding a portfolio built on a regime that is ending. That includes long-duration growth stocks. That includes long bonds. That includes anything that requires cheap capital to justify its valuation. When the cost of money rises, valuations compress. That's math, not opinion. Now, I'm not saying sell everything. I'm saying understand the wind direction, because Japan changed the wind. Here's a clue. When Japan could earn nothing at home, global markets had a constant tailwind from Japanese capital searching for yield. If Japan can now earn at home, that tailwind weakens or flips into a headwind. And headwinds don't show up in one candle. They show up in the grind. This is why I keep using the phrase slow squeeze. A slow squeeze on liquidity, a slow squeeze on leverage, a slow squeeze on valuations. Now, let's talk about the assets most exposed because I want you to be specific. First, mega cap tech. These are the most liquid winners and the easiest for big institutions to sell without destroying the market instantly. Second, speculative assets dependent on liquidity, smaller growth names, high beta sectors, and a lot of crypto. Third, anything levered to low rates, certain real estate segments, highly indebted companies, and pockets of credit. And then there are the hidden exposures.